Hey, what's up YouTube? Welcome to the Live Econ Guy. In this video I want to talk about why the Federal Reserve will eventually have to sell their mortgage-backed securities that they have on their balance sheet. Now, the Federal Reserve recently mentioned that they don't expect that they're going to have to start selling them, but guys, I'm going to show you why exactly they'll have to pivot and actually start selling them. And I'm also going to talk about the impact on the real estate and the mortgage markets. Now inflation continues to be an issue. It doesn't seem like it's going down at all, and because of that the Federal Reserve continues to do quantitative tightening. Now I'm sure a lot of you have seen this graph on the Federal Reserve website. It shows that they hold 2.7 trillion in mortgage-backed securities currently, and most of these are 30-year. They have a 30-year maturity. Next, I want to talk about some assumptions that I'll be using from my analysis. As I've already mentioned, most if not all mortgage-backed securities have a maturity of 30 years. And another assumption is none of the underlying mortgages of these mortgage-backed securities will go into default, because when they do, then the principal is not paid. Next, another assumption is that no prepayments occur because mortgage rates keep growing. And next, the Federal Reserve wants at least $35 billion in mortgage-backed securities to run off of their balance sheet per month. And lastly, the Federal Reserve does not want to hold mortgage-backed securities, which they stated. They only want to hold U.S. Treasuries. Now, to continue on with the actual analysis, as I already mentioned, 2.7 trillion in mortgage-backed securities are being held by the Fed. So we have principal plus interest being repaid every month to investors. If you don't know how mortgage-backed securities work, I highly suggest that you watch my video that I created recently about how those function and how they're different from regular bonds. Now, guys, we have essentially 12 months in a year and 30 years to pay back fully these mortgage-backed securities, which is essentially 360 months. Now, if we do this formula, 1 divided by 360, we get about 0.28 of a percentage of a mortgage-backed security being paid back each month. Now, if we look at this, then that means that about 7.56 billion is paid back per month. Now, that's only about 21% of the $35 billion cap that is that the Federal Reserve currently has that can run off per month. Now, the issue here is if we look at the time horizon, that'll take over 1,000 months to actually roll off of their balance sheet, which is about 88 years. Now, guys, in the best case scenario, even if let's say 35 billion were to run off per month, that'll still take them over 15 years to actually get rid of all of these mortgage-backed securities. Now, the reason I think that they're going to have to start selling them is because inflation is going to continue roaring, and their mortgage-backed security strategy is going to be considered very dovish. So I think they're going to actually have to start to sell these to actually at least meet that $35 billion quota. Now, a lot of people ask, how will this potential sell-off impact real estate, and how will it impact the mortgage industry? So that's a very good question, and we'll take a look at that. So what happens? So currently banks issue mortgages and they pack it into mortgage-backed securities and they sell it off to investors to lower their risks. What has been happening in the past decade is that they've been selling them to the Federal Reserve. Essentially, the Federal Reserve is a guaranteed buyer, so banks have been issuing all these mortgages. Now, in today's environment, the Federal Reserve is no longer buying these mortgage-backed securities, so banks need to be very careful, because either they keep these mortgages and take the risk upon themselves, or they sell to actual investors, and investors are going to be very picky. Now, if the Federal Reserve joins this environment and starts selling mortgage-backed securities themselves, they're going to sell them to investors or banks, and it'll probably be at a loss because the mortgage-backed securities that they're holding They probably have a low weighted average interest rate. And these mortgage-backed securities are guaranteed by Ginnie Mae, most of them, which means that they're essentially guaranteed by the U.S. government. So these mortgage-backed securities are going to be very appealing to potential investors, much more appealing than the ones that are being packaged today and sold by regular banks that are issuing mortgages. So there's going to be a lot of competition. I think banks are going to start to increase mortgage rates even more so that they could actually compete with the Federal Reserve. Um, so yeah, guys, I really think the Federal Reserve is going to end up selling. I mean, unless you think that they're going to take 88 years to get rid of all of these mortgage-backed securities. Plus, fighting inflation is very important. They've been reiterating that over and over. And last but not least, they did mention that that's on the table, the potential sale of mortgage-backed securities, because yeah, they did see that coming, that it would be a very slow roll-off. Um, so yeah, I'm curious to know what you guys think about this. I think it'll be a really interesting situation. I'm going to leave a few links down below, including a research study related to mortgage-backed securities and how they impact interest rates, as well as the Federal Reserve links and sources that I've been using. Thanks for tuning in.